This is AntaFX, and I'll be taking you through how I approached the day as Friday, how we traded. I trade ICT, and I'm going to say hi to you right here. Okay. Hi guys. Yes, that's me. Yeah, that's my bed right there. So, hi guys, let me take you through to this trade breakdown. I'm going to shut off my camera. Yeah, stay steady. Watch this till the end. Okay, so one day you're going to find yourselves in a situation like this. Let's assume price is at all-time highs. Yes, price is at all-time highs. Price being at all-time highs, the only thing you have is the previous day high and the previous day low. How are you going to approach the market? How are you going to survive as a trader? As for us who trade ICT, we know what to see, we know how to trade this kind of market conditions. I don't know about other strategies, but in ICT, you're good to go in this market condition. There is no past price action to the left, no current price action to the right. How do you approach the market? We are basically going on this day right here, Thursday, 28th August. Time check, I'm recording this at 1 a.m. in the morning, past midnight, UTC -3. Okay, I would have done a bar replay, but I haven't paid for TradingView. This TradingView you see right here is not paid for, it's free of charge to any trader right there. Let's start. All right, I'm going to break down Thursday and I'm going to trade Friday. As I've told you, price is at all-time highs. How do you approach the market? The only way to approach the market is this, and I'm going to show it to you. It's Thursday, and in this approach, this is how we approach Friday in our weekly range trading. This is how we approach Thursday. I want you to take a closer look. I want you to pay focus. You can get your notebooks. You can get anything. Let me hope this some people are going to learn a lot from this 20 minutes lecture. I'm going to lecture you. Uh, it may be somewhere, but I learned it from some people. It's a group of good people right out there. They taught me this for free. They didn't come to me and they teach me physically. I researched, I did my research, I followed to them somewhere. That's how I got to know about this concept. That's how I got funded. That's how I got funded. And I've been trading for over like 1 year and a half to 2 years. I think it's 1 year and a half. I've been learning to trade 1 year and a half. I've not been trading to get something any out of the market. I've been learning until I'm funded today. And I'm going to pass you through all this concept that got me funded. Is the concept I learned from some people. I've told you it's not my concept, but I learned from some good people who used it to get something out of the market. So let's start. Now, when you're approaching a concept like this, when you find yourself in a situation like this, you need to measure that daily candle. Whether it's bullish or bearish, I want you to take note of this. Whether it's bullish or bearish is what you mark out, and you mark out 50% of that candle. If the market is in expansion, remember it's at all-time highs. If it's still expanding, this is how you approach it. It's going to respect the upper half of that previous candle. It's going to respect the upper half of that previous candle. You are expecting a bullish candle, whereby a bullish candle, it opens low, it puts in a low in the upper half of that candle, that previous candle. It starts creating the body to the high, to the close. Now for us, we always engage ourselves in the wick making. When the wick is, the wick creates the swing that we are going to trade off in this market. Let me take you. All you have, remember, all you have is this previous, the high right here. Is that previous the high? This is going to be your draw on liquidity, which is Thursday. This is going to be your draw on liquidity. Altogether, we've marked up the upper half of our previous candle. We are expecting this next candle to form the wick in the upper half of this candle. Now, the next thing, this is finished. You have a draw on liquidity. You have a bias to follow. It is bullish bias. And you have a draw on liquidity. That is the narrative. Now, we are going to, since this is the daily, we are going to go to the 1 hour. Pay close attention, please, right here. Pay close attention. I need you to see something right here. I have 10 minutes more left. Okay, this is previous day high. This is the upper half of the candle's close. What we do is we mark out the open of the candle we are going to trade. The open. This is, it opens at 1800. It is a bearish candle. We mark out the open. We take it in your time. That is the open. of the daily candle. Now we have another open, which is the true the open. The true the open. All that forms before you are even awake. I don't want you to be coming to the charts like at in the early morning hours, at night. You are supposed to be asleep, but you're on the charts. That's not what I want you to be doing. What you should be doing is letting the market play out, and you observe with patience, with discipline. That's what we have to be doing. Just observe the market forming. It will start forming the things you know. It will start showing the things you know. Right. Now, when we are trading this concept, uh, when I have a previous day high, I'm expecting these three things. One, the day closed right there. I'm expecting failure swings to be there. When I'm expecting failure swings, don't pay attention to this I'm drawing. I'm expecting a failure swing. This can be that failure swing I'm talking about. This row right here. It can be the failure swing. It has a the failure swing. The second thing is the order block. The third thing is the fair value gap. Why? A swing formation is going to form around those things. A swing formation is going to form. And remember, price is fractal. What forms on the daily, it can form in on any other candle. You just have to follow the rules, because every strategy is built on rules. Once the rules are broken, you're done. The day opened right here, which is Friday, opened at 18:00. We use New York time. It's UTC negative 4. We use New York time. Be aware of that. You mark out your session highs and lows. Asia session, London session, all those you're not going to trade them. The only session you're going to trade is New York. Be it a reversal, be it a continuation, that's what you're going to trade. When it's a New York reversal, you're going to be in. When it's a New York continuation, it's what you're going to trade. It's what you're going to trade. Okay. Now, on the three things, what was here? What do you see? On the three things I've talked about: order block, failure swing, fair value gap. Of course, there is no fair value gap. You have to look in the upper half of this last candle, last daily candle. What do you see? What PDRA do you see right there in that upper half? Now, for me, you can pause the video and review. But now, for me, let me take this today. Video order back. Okay, it's back. Me, what I have a failure swing. That's number one, and I have a order block here. That's number two. But I'm going to take this failure swing. I'm going to take this failure swing. Now, this failure swing, the market has to form a swing formation after taking out the liquidity below that swing, after taking out this swing. Because why this is a failure swing, this is a high, this is another, this is a low, and this is another low. There are two lows right here. When you count this low and this low, where's the failure? These are called failure swings when they are two. they are failure swings. Once they take out this one, they are no longer failure swings. This low is no longer a failure swing. What makes it a failure swing is this low right here. The low here and the low here, they become failure swings. But once this is taken out, they are no more failure swings. Are we clear? So that's it. I expect a swing formation to form around this exact time, this exact place after taking out the failure swings or respecting this bullish order block. A swing formation is going to form. Am I clear? Yes, a swing formation is going to form. Let's zoom in. Hope this is its function is finished. Now we are going to the core content. Okay, this row right here, that row, this is a London row. Let me name it negative. Why is it negative? We use negative because once the liquidity is taken, I'm looking for buys at that position. I'm never selling when they have taken liquidity below London. I'm never on the sellers. No. That's why I put negative. I put negative because that could be deep discount. Okay, let me decrease this line. Don't know whether the minutes are going to be enough for us. I may make a part 2 for this video when the minutes are over. I don't know. That is London low. Now we have a London high. Here I'm going to mark it as positive. Why? Because once the liquidity is taken up there, I'm not looking for sales at that time. No, I cannot. I'm not looking for buys, sorry. At that time, I cannot. I only have to look for sales. If they are not there, I have no confirmation. I just leave the market to be and continue to the upside. So I'm marking out. Remember, this is not the time I trade. I don't trade London. I just observe what the market has done. So observing what the market has done can find me an edge to where the market is going and what am I going to expect. I think let me remove this. That line marks out the open. It has to be on your charts, not mine. Okay, this is negative. Oh no, this is positive. I think this is positive. Asia. Okay, we have a London high, you have Asian highs, you have a previous day high. What makes a failure swing? I'm going to ask you again. What makes a failure swing? I think I'm going to have to make a part 2 of this video. Let's stop this right here.